Welcome to the Dividend Talk podcast, episode 130, 2022 portfolio review. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to have a look back at 2022 and see how our dividend portfolios performed. All that and more. See you on the inside. Hey, European DJ. How are you, buddy?
I'm really good. New year, new chances, new opportunities, right? And by the way, Happy New Year, first of all, and Happy New Year to all our listeners. Let it be an amazing year with lots of compound interest, and dividend growth, of course. But tell me, how was your year end? And did you go for party or something like that?
Yeah, I mean, it was a busy Christmas. I know we spoke over Christmas as well. We had a show, but it's been one of the busier Christmases I've had. COVID was gone, everything opened up, so it was quite hectic. So New Year's Eve, for the first time ever, I was in bed before the new year came in. I was just wrecked. just I just I couldn't party anymore. I couldn't do anymore. But it was nice. It was nice. Back
Yeah.
to work this week, back to normality. So and hey,
Nice.
you're coming over this day next week. You should land in hopefully what will be the sunny southeast. It's raining at the moment, so I hope the weather's nicer for you next week.
Yeah, and I want to thank the community there, right? Because many people bought me a coffee with the goal to fund the ticket towards you. So yeah, it will happen next weekend. Next weekend we will meet for the first time in person, and we will do a live show sitting opposite each other. So I'm really looking forward. To make sure I take all my equipment with me.
Yeah, we'll see how that works, but I'm looking forward to it. It's going to be awesome. But hey, dividends. We're going to start the new year looking at what we did last year and how we performed. But before that, anything in the news this week? It's the first week, so usually it's quite enough, is it?
Yeah. Well, first of all, people are already looking at stock markets going up and down and up. So I haven't actually really looked at this week. I was too busy writing my own annual report. But today, Shell did a update statement. They do it actually always right at the beginning of the year. And one of the things that they also mentioned is that they will need to pay 2 billion in taxes to the UK and the European Union to, which effectively an additional tax levy that goes back to the countries to support the hike of, or to mitigate the hike of energy prices. And for me, as a Shell shareholder, and but even so, as kind of a bit of a capitalist, I truly hate this. I always say, like, there was nobody in 2020 when there was a minus in the oil price. There was nobody stopping at the gas station and stopping at the counter and said, "Oh, guys, I'll pay 33% additionally for you to cover some of your losses." There was nobody in parliament even suggesting that, like, shall we help Shell? They are making major cash flow losses and such. Shall we help them and pay cover 33% of their losses? But no, now there's a windfall, right? And then they need to pay 33% additional or something like that on the tax. So and an amount of 2 billion. For me, it is like, it really breaks capitalism when you think about it, because what they are effectively doing is they are letting us not benefit from the risk that we take. I know it's cruel, right? These energy prices and everything. We all are suffering. We are also citizens, but we're taking risk with investing in these companies, and whatever company it is. Today it's oil and gas, but maybe tomorrow it's something else. So for me, this is just a deep shame what is happening. I don't understand it. It doesn't mean that I don't have sympathy for people that struggle to pay prices, but then you need to do it equally, and in my opinion, just nationalize the whole energy business, pay us what's now on the market, and nationalize it. Yeah.
Yeah, I mean, well, what do they call it? A windfall levy. due to the excess earnings raked in from high commodity prices. So what are they doing? Are they taking this money and giving it back to the public, or,
That's the idea. That's the idea
what
that
is it?
they are already giving the public often like a ceiling towards the energy they will pay in some countries. So and this is what this gap in the budget will need to be covered with that, generally speaking. But that's my issue, right? I don't see them doing the other way. So these how they said the excess earnings, but there were excess losses. Yeah, in 2016, excess losses. In 2020, excess losses. Oil was dead. Yeah, here, and they were all happy with this, I think, because it allowed them to create these green woke policies and everything. But in the end, realistically, everyone is addicted to oil. We need oil, and it's just denialism. It's hypocrite, in my opinion, pure hypocrisy.
Yeah. Uh, Look, there's probably plenty that would disagree because of the high prices, but I think they've paid something like 4.2 billion in taxes now in the fourth quarter alone. That's what they were paying across the
Yeah, well,
world.
they need to pay the taxes that they need to pay, like regular taxes, right? Predictable. Like, that if you're, I don't know, for instance, seated in England or in the UK, I don't know, what is it, 10, 15, 20% corporate profit tax. And they need to pay that. That's normal. That as a shareholder. But, we had to suffer from large dividend cut in 2020, the first time since the Second World War. We had a lot of price depreciation. Many people were scared during COVID, and there was really nothing there, right? The market was left on its own. Yeah, and this is why I hate it, that when there is an upside, they're roaming it off, right? The profits. So, and yes, these are large profits, but this is in the end, it's a question of supply and demand, and that's what these business models are built on. And I know energy is always sensitive. That's why a lot of the power operators, natural grids are in many countries nationalized, or there's a large stake of the government in there. But this was not the case with oil and gas. Yeah, they have already, like, when for instance Shell is in, I don't know, in Qatar or something like that. They have joint ventures everywhere, and half of the profits, usually the country or the nationalized oil and gas company owns 51% of the joint venture, and there's profit sharing there, revenue sharing. So
Yeah.
there's really double dipping, right, here.
Yeah, yeah. I look, it's definitely coming out of our pockets, definitely, because that's two billion or so that could have went towards buybacks or dividends. So I don't agree with it either, but hey, it is what it is. Walgreens reported earnings. I didn't look at it, so I am rereading their annual report this week. That's what I've started, and I'll get to that maybe at the start of next week. But I see you've highlighted some interesting things from them.
Well, yeah, I brought it up for you. You're the WBA guy here in the podcast, so I really want to share it with you. But they had a first quarter loss per share of 4.31. For the first quarter, compared to 4.13 in, I believe, the a plus a year ago. But they had a 6.5 billion pre-tax charge related to the opioid litigation. Also, what Johnson had to do and such, right? Share
Yeah.
price dropped a lot as well. I think 7 or 8% in response to that. Adjusted EPS. So this is what management likes to tout, right? Because that's the number they can make the most prettiest. Still decreased with 31% compared to last year. So which is also a lot. But at the same time, they are maintaining their full year outlook, and actually they say that they increase clarity into the company's long-term growth algorithm. I like that one. That's such a bullshit when you read this, right? But building to low teens adjusted EPS growth in fiscal year 2025 and beyond. So when you think about this, you're getting this company according to their own forecast at a 7 or 8 PE, and you will get
Yeah.
low teens EPS growth. I mean, if this is like this is really like man, this would be a growth stock.
Yeah, I mean they're trying to pivot, aren't they? I think they realize they're behind CVS a long ways now. CVS are a little bit more integrated and control the pricing power a lot better,
Yeah.
say, than what Walgreens do. And they are trying to pivot into some localized health and become the
Yeah.
integrated health. How that's going to work long term, it's still unknown. It's still unknown. It seems
Yeah.
like a good idea. It really does, but whether it's going to play out as well as they think it is, I don't know. But certainly, if you were to choose between Walgreens and CVS now, if you're sitting there with CVS, you're looking a lot prettier.
Yeah, there's a lot of bullshit in this in this earnings report, I would say. So quite some red flag. I mean, long-term growth algorithm. How do you even invent this? It's like the same as when you are at work and they say it's not a challenge, it's an opportunity. Yeah, we, we and
I mean,
also they had a lot of theft in the shops, right? So they invested a lot in security officers and everything, and they're pulling back again from that because. And then I think, like, guys, are you a bunch of clowns?
I mean, they're trying to pivot, aren't they? But in pivoting, they're trying to make it seem rosier than what it is, and that's what they're doing. Whereas
Yeah, yeah.
they would be much better just writing exactly how it is. Look, we're far behind CVS. They control the pricing power. We can't compete with them. We're pivoting into this new market now. That's where our eggs are going.
And the share price will be at exactly the same place where it is today because the shareholders don't buy this shit. Yeah.
Exactly, but they'd have a lot more shareholder trust, I would think, if they did
Yeah,
that.
exactly. And there would be probably more case for long-term investment then.
Yeah,
Yeah.
yeah.
So I'm staying away from WBA, although it looks from the metrics sometimes really attractive when you look at the yield and such. But I'm not saying that they will cut the dividend, but I'm because of this, it's not a high quality company, and that's where really more of my focus is right now.
Yeah, I don't think the dividend is in danger immediately this year, but we don't know. Maybe if it continues 4 quarters in a row of losses like
Yeah.
this, then this time next year
But
could
this
be a different story.
opioid case, so if it's a one, this could be really just a one-off, right?
Yeah, yeah. Hey, look, time will tell. But I don't think the dividend is in danger. This is a turnaround. It's similar to Intel. It's a turnaround
Yeah.
story. I like the idea of it, but whether they can make it work and play out the way they say
Yeah, but if you
is
then
not.
hear
Is not.
Pat Gelsinger talking, it's total different ball game. You just hear the engineer in Pat, right? And you see sometimes that he's more making mistakes, but it's more out of I think let's say like that. Pat has no bad intention, and he is also really straightforward. When it's shit, he says it, right? So that's probably what you say, what you mentioned just before. But hey, let's say the third news item that I want to talk about is OpenAI. Because it's currently they have a new funding round and it's currently being valued probably around 29 billion. And we could probably just say like write a Dividend Talk episode for us in OpenAI and put a like text to speech module on it, and they could just make a conversation for the listeners, right? The 29 billion. And um, I also saw that somewhere already that Google's really now the CEOs are really putting their workforce together, saying like, okay, guys, this is the threat. And what is really nice that I want people to remind is that in 2019, Microsoft invested 1 billion in OpenAI, right? So this clever little guy there, Satya Nadella, he is like everywhere is stakes. Yeah, and I really love this when I read that. Like, okay, if Google loses some, there's still Microsoft behind it here. Yeah, so I like this, and I think they wanted to integrate it already in Bing, also as an alternative search engine or something like that. So this is going to be really interesting for me. I really like this kind of technology shakeup. By the way, I'm long Alphabet.
Yeah, look, AI is definitely the future, isn't it? In all walks of life, it's definitely the future. But we'll see how it plays out. But I did not know that about Microsoft. I'm surprised wasn't included in the co-founders. To be fair, there's some big names there like Elon Musk
Yeah.
and Sam Altman and stuff. So I'm surprised they weren't involved in that, but they didn't want to miss out on their slice of pie, so they invested
Yeah,
1 billion.
exactly. Good. So to be continued. I believe a new GPT release will also come in March or April. So yeah.
Nice. So 2022, you wrote this big fancy annual report. I've got through half of it, I have to say. So tell me, how was your year? How did you do?
Well, I think probably quite some of the listeners have read it as well. So I'll try to avoid re-speaking, let's say, retelling the whole annual report. But initially, before I started doing the numbers, I felt so, because I tend to remember my mistakes more than my winners and the stuff that we did well. And then when I do the analysis, I think like, shit, this was a pretty damn good year, actually. Yeah, I mean, my savings rate 50%, 51%, and this is what I always remind people. Like in the early days, if you can save more, you build quicker your projected annual dividend income than from the return. Yeah, because let's say if you can save 25% or 35%, this 10% difference that you can invest gives you already much more dividends than a single dividend hike over holding that company that you had for such a long time, right? So the cash we deploy in the early days, let's say, specifically up to the let's say 150K or something like that, you see the impact directly of the savings rate really strongly. And for me, therefore, I was really happy still with the savings rate, because we had shit inflation here in Poland, 17% year over year. I mentioned a few times already, our market rate is now 10% interest rate. So for me, this is what I was really proud on. And also, yeah,
Did
40.
did you have to cut back on anything to keep your savings rate?
No, not necessarily, because you know what makes life so easy in this? I pay myself first. So before I do anything, as soon as my salary get on my bank account, poof, certain amount goes already to the brokerage, and then I have to try and survive on the rest. Yeah. I get also money from my wife sent straight away when the money comes in. So paying yourself first is for me such an easy trick. That's why I also stopped with expense tracking. I'm not doing that anymore as such. How I calculate is just I look at the salary that came in, I look at how much money went to my brokerage account, and I've got my savings rate. I don't bother anymore about expense tracking as such, because I build a routine over the years. So I kind of know where my expenses are. Yeah. And I know whether we spend a lot on vacations last year, because you just know that, because you do the counting. Okay, last year I went one time on vacation. This time I went 3 years on vacation. So, wow, no surprise that expenses on that went up, right? But I think it's really important in the first 2-3 years, at least that's from my experience, to really track all your expenses continuously, because you need to really often it's hard work to lower expenses, right? Because, for instance, you can lower your expenses by paying off mortgage. It's a really really easy one. That's the biggest one. Your car loans, yeah, in the beginning. Because often people start with a telephone subscription or something like that, but in the grand scheme of things, those are not the big ones, right? Refinancing your mortgage, those are the big ones that you really can save money on. And it takes 2-3 years to rebalance your expense accounting book, let's say. And from then onwards, you just live on that, and you need to avoid lifestyle inflation. So yeah.
Hmm. Nice, yeah. It's just with inflation, I would imagine a lot of people's savings rate might not stay the same, especially if you're living a certain standard of life and you want to keep that.
Yeah.
Sometimes you're going to miss out of entertainment, or you're going to keep
Yeah.
saving. So it just depends on.
So maybe it's good to clarify. My savings rate is lower than last year, but that has also to do because my gross income this year was higher, so that also reduces a bit the savings rate. Yeah, but also that's another thing I say, like, to have a high savings rate, do your best at work. So I got some increase also in 2022 that didn't fully make up for the inflation, but well, actually, probably yes. Let's say like that. If you have a savings rate of 50% and your expenses grow 20% and your salary would grow with 10%, kind of your inflation is covered. Yeah, it
Yeah.
was not entirely the case for me, but it just shows like that here also there's like a leverage effect or something like that. Yeah.
Nice. And then what about dividend growth? What about dividends? How did that do?
Yeah, so the dividend growth itself was, of course, like my projected annual dividend income grew with 40% or something like that. But my organic growth was 4.3%. and this is what I'm not satisfied with. It needs to go to 6%. And but this is a long-term story, because Omega Healthcare is a really big position for me with 8% yield. It's been flat for 2 or 3 years now. If this doesn't grow, yeah, it impacts the growth rate quite a lot, the organic growth, right? Unilever didn't grow their dividend. Danone didn't grow the dividend. So I've got few of those companies in my portfolio, let's say in the top 15, where if they don't grow, it impact the overall number. I am not too worried about it, because my financial plan is to have a 3.25% yield on cost. That needs to grow 6%. But if you've got Omega Healthcare already at 8%, I bought Apfi at I don't know, 6% yield on cost. So it would need 10 or 15 years, usually let's say 10 years, to get to that number, of the yield that I have already. So it's not that such a big of an issue, but my portfolio yield is now around 3.7%. I have some opportunities to boost it up, because I've got some non-dividend stocks in there, like Alphabet, Meta, and such. So maybe I'll do something with that this year. I'm still figuring out if I want to do that here. So yeah, it's by now investing in more high quality stocks like Texas Instruments. I hope that this organic growth starts to improve, because once I'm financially, let's say, early retired, let's say, and let's assume I wouldn't have any income anymore other than my passive income, that is my sole salary hike that I will have. So it sounds really nice that I hike my projected annual dividend with, I don't know, 40% or something like that. But this is not realistic if I don't deploy cash from active income anymore in the stock market, and I solely depend on passive income. So that's why I'm focused on that, to strengthen that passive income organic growth over time. And
Yeah.
I don't think a lot of people in the community track their organic growth here. They usually look just, okay, this is what my projected annual dividend income growth is, da-da-da, and that's it. But it's not a real number, right? Most of it comes from the cash that you deploy in the market.
Yeah, it's a lot harder to track the organic growth as well. It takes a lot more time to
Yeah,
do
so what
so.
I do, maybe to help people out, I just look at the amount of shares that I owned, let's say at the start of 2022. Then I look at the dividends that were there at 2022, 1 January. Then I look at the dividends at the end of 2022, 31 December. And then I just calculate it, and that's the delta. I don't look at the stocks in between that I purchased or that I added, because it would really blur the number. For me, that's a good enough number to justify it being the organic dividend growth. And that's how you can calculate it. It's a clean number. Then you don't need to do anything with, I don't know, total return kinds of concepts. No, it's really clean. And they just told me, if this was on 31 December 2021, the status, how does it look like at 31 December 2022 on the same basis of the amount of shares? And the only thing where I add shares is when it was reinvested, like Shell or Ahold Delhaize, because then that is also dividend payments.
Oh. And the companies then that you have that are impacting your growth. Say you mentioned Danone as one that we know is not growing dividend. Any thoughts on them? Like, do you see the point in holding on to them long term?
So I put them on the watch list, but this like the watch list, the CEO watch list, like don't fuck up on this one. So I kind of like the new CEO from Danone, from what he has been doing. But I expect things this year to trickle down into the bottom line. And with that, I expect a dividend hike. If there's no dividend hike, I will really, really reconsider my holdings, because I really wonder. Then I need to then really understand what the CEO is up to. Maybe he's not interested in dividend at all, and then there are opportunity costs associated to it. And I have the same with Bayer as an example. I had already last year on the watch list. I didn't touch it this year, but there are opportunity costs. So yeah, I might sell them then in my spring cleaning or something like that, because that's in May. That's after all the earnings, annual reports. It's after the general meetings, and then it's a good time to consider selling or not.
Cool. So overall, good year. Happy with your results.
Yeah, I'm really, really happy. And let's not forget, a lot of it is also to thank towards the dollar here that got a bit stronger. I think it impacts 5 to 10% of the results. But hey, you don't watch a gift horse in the mouth. But on the other end, I had to pay more for American shares also in the second part of the year. So it will hit us back once it would, if the euro will recover, right? So
Yeah.
yeah. No, I'm
Right.
really proud, really happy, and yeah, and for what it matters, if you take the same approach, I had even a 1% capital gain, net capital gain on my portfolio. If I don't look at all the additions, just like again from last year to this year with those things, while the S&P 500 went 20% down. So last year I was 6% lagging the S&P 500. So over 2 years, I'm still 14% beating it. So anyone who tells us that dividend investing is boring and it's not gonna make you money, well, there's one thing here, guys. If you are able to not lose money in those years, you're actually compounding still, right? So yeah, it's a fun statistics. It doesn't matter to me and such, but if people challenge on total return, there you go, guys. Having a value oriented investing style also gives downwards protection.
There's not too many people that can say they've smashed the S&P 500 by posting positive returns this year. So kudos to you.
Oh, kudos to Shell, ExxonMobil, and all the managers there.
Kudos to big oil companies.
Yes. But tell me, I'm curious. Enough about me. How about you? How have you been doing this year?
Yeah, my year was okay. I had a goal to invest 1,250 a month. I bet that, so I averaged around 1,400 a month, which I'm quite happy about. Roughly, my portfolio yield, remember I mentioned, is like 6%. So at a 6% yield, that's an extra 1,000 a year in dividend income. At a 3% yield, that's 500. So
yeah. And then
in
how
and
come
around
you
that.
were able to increase the money? Why 1,400 and why not 1,200?
So I do, I do work for a short dividend and stuff like that. So all that, pretty much most of that money goes straight in. There was maybe maybe 1 month where my wife needed money for something and it was there, so I gave her that. But normally I just throw that money in there as well. So that kind of contributed a little bit to it.
So it's a bit side hustle.
Yeah, a little bit of a side hustle there. So it's there. So I'm aiming to go to 15 this year. That's the main goal, 15 a month this year.
But are you also paying yourself first?
I paid off, yeah. So that comes out straight away. So two things happens when I get my wages. Automatically, the money goes into a joint account for all the bills, and automatically this money will go into another account that I'll put into my investments. So all that comes straight away, and then whatever I'm left with. But that's what happened.
And these were deposits, right? This was not dividends reinvesting.
No, these are
net deposits. Yeah,
all deposits. Yeah.
Congratulations, and it's a lot of money, right? 1,400. I don't know how much you earned like 5 years ago, but for me, these are like just 4-digit numbers are really a lot, right? Really a lot.
Yeah, like when you think when I started in 2007, end of 2017, I was putting in 100 a month. So
exactly.
No.
And now it's like a 14-fold.
Yeah, and you can really see that in the dividend income then throughout the year, particularly towards the end of the year. So you can definitely start to see the money at work. Now I did have one exceptional month, May, where I earned 800 euro, but most of that was, remember, was in ZIM. I was doing a dividend capture, so it's hard to include that in calculations. But I think, look, forward income for next year stands at the moment at about 3,200, roughly 10% of my overall goal, which is obviously 32,000 if you can do maths. So it's pretty pleasing.
That's like 250 euro a month already.
Yeah, that's 200, just over average, just over 200 a month at the moment.
And what can you pay all for that? Which bills does it pay already?
It it will probably pay my gas and electricity bill at the moment. That is due to go up. They sent us a mail yesterday to say, oh, you've had incredibly low rates, but next year it's going up. But it still cover gas and electricity, and probably my mobile phone bill as well on top of that.
Yeah. Yeah, and this is how I look at it. I look at the bottom of the Maslow pyramid, and those are the expenses I first want to be able to cover, like housing, like a
Yeah,
shelter or a real roof, right? Energy, food. If you
yeah,
cover that, we have our psychological needs, right? And we know actually that you already can survive. Yeah,
yeah,
so that's the first threshold where I really look at here. Nice.
yeah. I mean, I'm a good bit off covering food and house, but
Yeah,
I mean, it's a start. It's a start. Definitely,
exactly. Exactly.
it's definitely interesting to see. Like 10%, uh, 10% towards my goal. I thought I'd be more. To be fair, I did actually think I'd be more. But then I'm looking at it. I did have a lot of money within options and all that from last year's, as you remember. The sack probably hampered me a little bit, I would say, because that's money that was sitting there that I
Yeah.
didn't use, that I probably could have put towards, especially when we had large dips. I could have used that money a little bit better. Instead, I was sitting
Mhm.
there and rolling over options. Actually, fun fact, I did say that I was getting out of all my options and so on, and I had VFC was last, so I
Yeah.
closed that at a loss yesterday. I was just said, fuck it, I'm not waiting anymore. I just want to get out. I don't want to keep holding the cash on the side, so I closed it off. It's a loss, so I have no more open put options on my account
Yeah.
anymore. So all that money is going to be deployed. That's sitting there this month or next month into
Oh,
dividends.
nice, nice, nice. Let us know in what. I'm really curious.
Yeah, I'm
DCC.
look.
Are you going to do DCC? That's a question, really.
I have a few shares. I have about 15 shares of them.
Hey, you
So
bought some.
yeah, I bought some. I bought some close to when you did. You called me out on Twitter, if you remember, and I said I have to buy
Yeah.
some. Yeah, so I
Ah,
bought I
nice.
bought about 15 shares. So I don't know. I don't know what I'm going to buy yet. I bought some Sunoco. Remember I mentioned them? I bought some of
Mhm.
them this month, and today I bought some more Blackstone and another share or two of Texas Instruments as well.
Oh, nice, 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 nice. Good. And what about your portfolio yield? It's 6.3% or something like that, right? Is this something
Yeah,
that because what is your target, right? Because I assume you have also kind of a like for me it's like savings rate. I need to do 50% every year. And then need to do 3.25% on average plus 6% growth. So if I'm above that yield, I can expect a little bit less growth. But do you have those numbers as well in your head? And
yeah. So most of my calculations were done off a 3% dividend yield, a portfolio yield, and then around 6 or 7% growth. So pretty much the same as you. So all my calculations are done off that. It is a little bit higher, but I do have some higher um, yielding. Like I do invest in CEFs, closed end funds, which I don't really
Mhm.
talk about it because I'm not, I would say, an expert. I don't want to give false information, but it's
Yeah,
definitely more tax efficient in Ireland to own them rather than ETFs, for example. And then it give me access to sort of equities and markets that I just can't get in traditional markets. So they typically give me about a 7-8% yield. So they do
yeah.
pop up. I have about 5 or 6 holdings
Hmm.
in them. So that's what's really dragging it up. If I was to take them out, that yield would probably be in around 4.5%, which is a little
Yeah,
bit
yeah.
more manageable.
Okay. Cool. Cool. Cool.
But like you, I do want to start tracking the growth a little bit more. We do say we're dividend growth investors is what we say. So I think it's important to try and track that just to make sure that the companies we hold, for example, because I had those thoughts about Danone as well. Are they actually growing? Or what's the point in holding on to them if they're not going to grow the dividend? Sure, it doesn't
Exactly.
seem
Exactly.
it doesn't. I mean, you have a strategy, you have ethos, and if they're not fitting in with it, then you have to really think about why
Mm.
they're actually there.
Yeah. Yeah. That's how I look at it as well. Okay. And then what are the buys that you're really most proud on from 2022?
Siemens was the one that because I really
Yeah.
really wanted to own, and I really like Siemens, and I held off, and then they dip back down. So I'm glad I went back in for them. I do like Sunoco as well. I do actually like that one. They're a packaging company. I wanted the Irish company, as you know, Smurfit Kappa, you'd be laughing about, but I think Sunoco is a really good company. And the last one is Schneider Electric. I've been holding off on them for so long.
Yeah, and I went to the shop the other day and I saw like Legrand, Schneider Electric, all the switches were beside each other. It really felt like being on a stock safari here. It was really nice. And they're all French companies. What do French companies have with switches?
I don't know, but a
Or
lot of them
yeah.
cut their dividend, didn't they, recently? So it's quite good to have one in your portfolio that hasn't cut their dividend.
Yeah, I was just wondering when I was walking there. Okay, Legrand is a French brand. Schneider Electric is there in France. And I felt like, do they have something? But did they invent switches? Like, did Napoleon invent the light switch, or what is it?
I
Yeah.
don't know. But they make good products.
Oh,
So
maybe we have a French listener that can clarify a little bit, like about this. Yeah.
it would be actually interesting to know. That would be, well, for me it would, because
Yeah, for me as well.
yeah, but I mean, look, there was some force buys in my account. You can see that I have some there. So Zim was there, ZIM, CCL, Carnival. I told you I bought them. I thought the cruise industry was going to turn around, and a couple of others. Like, so I've sold maybe 40-50% of them at the moment, and this year I'll be just getting rid of them come hell or high water, and having just a pure dividend growth portfolio. That's the main goal.
Are you happy with the performance?
Yes. In terms of dividend growth, but again, you touched on it. Lots of people don't track the organic dividend growth, and I didn't. I've tracked obviously dividend growth, but there's 17,000 gone into my portfolio, which has obviously helped that. So I need to track it from a dividend growth organically and see if I'm happy.
Yeah, run your calculations and let me know.
Yeah.
I'm curious.
But in terms of value from where it was at the end of last year to the end of this year, I'm obviously ecstatic. I'm more than happy. It's a 50% gain, so it went from 2,000 up to 3,000 in the space to be up.
Nice. Congratulations. And wishing you that in 2023 you do another 50% at least.
Yeah, I hope so.
Good. Hey, with that being said, I think cheers on a good year. We'll drink next week a pint on it. I heard I need to try some of the Guinness there, so my expectations are high regarding that. But maybe this is the time we can also go to the listeners' questions.
Yeah, cool. So the first one is from Phil, and he is asking us. I think you already said in previous episodes and end of year reports, but what is new and different?
Yeah, for me, it's really I need to spend more time on high quality stocks, and this is where the stock market is also now in a much better position. So, I mean, it was already a bit in there, but also what's new for me in this year, I'm really thinking a bit more deeply now, like, what does that mean? Yeah. So I know I need to do high quality, but what does it really mean? So I'm still thinking a little bit like, what makes something high quality? Yeah, and I'm more doing some deeper thinking about this right now, and based on that, yeah, I might need to make some adjustments to the way I analyze stocks or buy stocks. I think I have it all already in there because, for instance, the dashboard that we built covers all of this. It's a dividend safety and such. But I want to make sure I do proper due diligence around this so that I really can buy with conviction. Yeah, and that I can also clearly, how do you say it? Separate the chaff from the wheat. Is it that?
Something like that. Yeah, I can't remember the exact phrase, but
yeah.
Yeah, I agree with you. What is quality, and defining that is important. For me, I'm going to go back in time on Twitter and have these laser eyes. I'm going to be laser focused, purely on dividend growth this year. That's what's different. So I'm staying away from all the fiddly bits this year and laser focused on dividend and my dividend growth portfolio.
Nice. That's nice.
Hobby investor, do you foresee any potential legal issues for Europeans when buying American ETFs via the recurring order book from interactive brokers? I'm honestly going to say yes. That is why I am staying the hell away from it.
But what kind of legal issue can you have then?
I don't know, but a tax or something. I don't know what will come from it, but I mean, it's not possible to buy these shares for a reason. We're obviously protected in some way by the
Yeah,
European courts, so I can't see this being. I can't see them willingly giving. I don't know. I don't know. It's hard. It's hard
yeah.
to know.
But some financial institutions can buy them for us in Europe, right? So yeah, I mean I'm not a lawyer, obviously, so I don't know. But maybe some people might not know what we're talking about. So maybe full disclosure on interactive brokers, if you have an account there, many people have seen suddenly, and besides the buy and sell button, something called recurring. If you click on recurring, and then you look up the ticker, for instance, SCHD, the Schwab Dividend Growth ETF, suddenly you can set up a recurring monthly investment, let's say of 100 or 200 euros, and you can start buying these ETFs that were never accessible to us. So the big question is this a feature or is this a bug? Nobody knows, but some people already started to buy these famous American ETFs there. And the question from hobby investors here, like, will we be in shit in a few months from now or not? So we don't know. I'm a bit more, I guess, of something like who doesn't mind, you know, taking the opportunities that are given to us and live with the consequences later. But yeah, if you're afraid of that, then of course, obviously, don't do it and treat it as a bug and report it as a bug.
It's you know what? Probably it would be more interactive brokers that would be punished legally. I would say, if anything, rather
Yeah.
than the individuals.
Usually it
But
goes on the broker side because we've seen it with the Giro as well at a certain moment that they sold, no, that they didn't allow us to buy real estate investment trusts anymore.
yeah,
Remember that?
but I mean, just imagine if it's a long-term holding and you buy them and they drop 50%, and then all of a sudden some rule comes in and they're forced to sell the shares and give you back the money. You would be pretty pissed at that stage.
Yeah,
So
but if such an ETF drops with 50%, we have another issue going on.
yeah, maybe we'll see. Recession is coming, baby. We don't know what's going to happen.
Yeah, but they don't happen in overnight. It still
I
takes at
know.
least few weeks.
Dazzy Mike has asked, how big of a factor does dividend withholding tax play in picking one dividend stock over another? I know your answer.
Yeah, dividend after tax, yield after
Yeah,
tax.
yeah. It's still hard for me to invest in companies in Switzerland and places where it's like that. And where did we say recently had a high dividend tax? Was it Sweden?
Norway.
Norway,
Yeah,
Norway, yeah. So, I mean, for me, it's definitely psychological because dividend after tax probably makes more sense, but paying 35, 45, 50% of your income is just hard to swallow for me.
yeah, true. But you pay it now in your active income probably as well. Because that's the fact, right? Dividend income is
Yeah,
still usually taxed better, so lower tax than from active income. If you're working in the Netherlands, you have 40 to 50 or 60% income tax. Yeah, then you can better have dividends for 15% there.
yeah, true, or 35%. But
Yeah,
it's all relative, isn't it? I suppose when
yeah,
your active income, you're probably earning a lot more, so you swallow it. Whereas if I'm buying 1,500 euro worth of shares in, I don't know, Nestle, for example, I'm losing
yeah,
35. But I'm not going to bother trying to claim that back or do anything with that. And such a low amount of money, it doesn't
yeah,
seem like it's worth my while.
yeah, yeah. True, true.
Gordon has asked us, do you get tired, impatient for waiting like stocks like Nike, L'Oreal, Botox, Clear to drop to an acceptable price, or do you think dollar cost averaging instead is better?
It depends on the day. Today, not ask me tomorrow again, and I might be pissed off. Yeah, no, I'm in it for the long run, and I don't like overpaying for a company. So it kind of Yes, I have more sometimes this fear of missing out kind of feeling, like, okay, maybe I should just buy it. But then I had this feeling more like last summer, and then I see where they are trading now. I think like, nah, I'm glad that I stuck to my philosophy here. So, and I always believe that at least once in a decade they come at a reasonable price for whatever reason.
Yeah, you just have to be ready for it, I suppose.
Yes, exactly.
Yeah. Okay, Neil has asked us one question for you. What do you think of KPN?
Yeah, so KPN is a Dutch telecom provider. They are currently forecasting a 3 to 5% dividend growth and already pay around 5% yield. I mean, KPN is for me not a business that I consider high quality, actually low quality. I know they are strong, have a strong market share in the Netherlands, but there's always something with the stocks. There was a Mexican takeover or something like an investor at a certain moment. Maybe he's still there, but then I think, okay, but if you want this, and then go for Verizon or something like that. Yeah, there's more quality in Verizon, and probably at a similar yield, even a bit higher yield. So for me, KPN is a stock that doesn't attract me at all.
Telecoms in Europe are a bit more choppier than
Yeah,
American.
exactly. Yeah.
Yeah. Hey, and on that, AT&T are in talks of cutting their dividend again. Just fun fact.
Yes. Again?
Yeah, yeah. So that's the rumor on the grapevine that there's talks of another dividend cut impending. So that'll be
This is
interesting to
this
see.
John Stinky. Is he still there?
Yes, he's still there. Yeah.
Fucking hell.
So
Do
we'll,
you
we'll
still own your AT&T shares?
I still own them. Yeah, yeah. I still own 'em.
I thought you wanted to sell them like a year ago.
Yeah, right. I'll tell you at this stage. I mean, I don't know. I'll have to revisit them. But there's definitely talks of them having to cut the dividend again. But I'm
And
not.
why?
Well, let's think about it. I mean, they're in debt up to their eyeballs and in high interest environment at the moment. So
Oh boy.
that's never a good mix in anybody's case. But again, it's just, as I said, it's just a rumor. But we'll see. Usually, when they start, there's probably more to it
Oh boy.
than meets the
Well,
eye.
sorry for laughing at you. No bad intention, but this AT&T is killing me. I
I
mean,
know.
I glad I stepped out really almost immediately, and still I got a nice profit out of it. So
Yeah,
in the end, I did well with it. But yeah,
one of the lucky ones. Um, Bart has asked us, so he's congratulating you on your super annual report. But you say you expressed that you're underweight in high quality and you're overweight in value stocks. If you were to reallocate from 47 down to 15, what are the 15 subsidiaries of high quality would you keep?
oh yeah. Give me a second.
While you're doing that one, the next question seems like it's from Ireland. I'll answer that one while you're doing that. It's from Thomas. He's asked, do you have to declare your stockbroker account to revenue? The answer is yes, you do. You have to declare any income that you get. If you buy shares, you don't have to declare, but if you buy and sell, you have to declare. And if you receive dividend income, you also have to declare.
Yeah. Hey, getting back to the question, yeah, of course, I would keep Shell, I would keep AbbVie, I would keep Koninklijke Ahold Delhaize, I would keep Microsoft, I would keep Apple, I would keep Johnson & Johnson. I would probably keep BASF. I would keep Realty Income. I would keep Allianz. I would keep HP Inc. I would keep Munich Rijksversicherung. I would keep T. Rowe Price, PepsiCo, Chubb, Hershey, Texas Instruments, DCC, Siemens, ASR, Netherlands. I would keep Target. I would keep Starbucks. I would keep
You're on.
Defama, and I would keep Defama and Ambra from Poland as well. Yeah.
That's 23. So you're already gone over 15.
Oh, okay, but these are kind of high quality stocks for me in my portfolio. Yeah.
Okay. You
Oh, and
said probably.
ASML. Sorry, I forgot ASML. I will keep
Yeah.
that one as well.
You said probably BASF, so maybe that's not as high quality as the rest of them. You were on the
Well,
fence.
because BASF is cyclical, and like Shell as well, I guess. And why I'm there on the fence is like, can you in general consider cyclicals as high quality? That's a more difficult question for me.
Depends on where you buy them in the cycle.
No, but that's high quality. You shouldn't look at price, right? You should look really at the fundamentals of the business. Does it have a mode? Can it weather any storm? These kinds of things. Market share, growth potential. Yeah.
Yeah. No, I agree. Okay, and then Dermot McNamara has asked, he uses the Hero, but after Mike's post about broker diversification, he's thinking about opening other accounts. What are some of the pros and cons of the ones that we use?
Okay, so Interactive Brokers, you've got access to many stocks all around the world at probably probably the cheapest prices, I would say. However, the user interface is just a drama. I struggle with this stuff like after a year. I don't understand how you can create such a web interface in 2023. They should feel ashamed. But again, people are not there for a fancy web interface. They're there to earn money. But for me, just to be able to pull a simple overview to see my dividend income, I need to create a report, like generate a report or something like that. And I think like, what the fuck, yeah? Just show me straight away. Let me even tailor a little bit of web view. It can't be that difficult. So that's my issue with Interactive Brokers. And there's where I like the Hero really a lot. I really like their web interface. The portfolio, really nice overview. Below the portfolio, you see all your dividends that are upcoming, really in a nice table. But what I don't like about the Hero is sometimes like you have these the watchdogs are chasing them. Now again, something in Germany that tend to intervene a little bit. So sometimes I wonder, like, will we see in FTX that they were telling us that our money was in a safe deposit, let's say, or our shares, but in the end they were just hustling with it. Yeah, that's kind of this thinking sometimes that comes to my mind because of all this news that we then see. But also European shares trading is not so cheap. I pay €4.5, €4 on a commission on buying a stock abroad. Yeah, and then an Interactive Broker has better commissions here.
Yeah, I like Interactive Brokers, but I agree. Logging in to try and find my dividend income is a pain in the backside.
Yeah,
It is absolute pain. I mean, you're right. You have to go and create, like on my mobile phone. If I want to go on using my mobile phone,
forget it.
it's impossible. Like you have
Yeah.
to jump through hoops to try and even do that. Whereas on the Hero, you can go on, you can go to transactions, and it has boom, everything there. And so
Exactly.
it's so much easier. So that really annoys me because it's more of an effort for me having to track stuff from there. But
Yeah.
in terms, you're right, you have more access to markets and stocks and everything else. So and cheaper. I think it's cheaper.
Yeah. I think it's the
well.
cheapest one so far that I know. Maybe trading 212, you can say it's like free without commission, but you pay on the spread. So in the end, I notice you do spend 1% or something like that on every trade. It's just like how they communicate it. It's like it's zero commission. Yeah.
Yeah, and you don't get your dividends on time. So I don't know if you noticed that. So it's always like a week later. Dividend.
Yeah. So I mean, I have a pie there that I invest a little bit in it. So, or two pies. So it's for me, I don't worry so much about how quick it comes. At least last year, Trading 212 updated the annual reports, annual statements. So now we know our dividends, so I can use for the tax returns. So they're improving slowly. But for me, usability, Trading 212 is top notch, right? With the pies and the fractional shares, it's really top notch.
Yeah. Cool. Come to the end of the show. Thanks a million for everyone for all the questions. Thanks to you for going through your portfolio. And again, your annual report is definitely a must read. As I said, I'm halfway through it. It's very in depth. It's very good, and definitely an exercise worth doing. Actually, for anyone that's a dividend growth investor, you don't have to write it as in depth as yours, but definitely to go through the process is probably going to be helpful.
Thank you as well. And hey, let's see you next week in person.
Yes, we will. We'll have a live podcast next week. I'm looking forward to that.
Good, great.
Okay, see you all on the outside. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.